Okay, class, this is chapter 18, what finance is all about, what financial managers do. I would say that chapter 18 and chapter 17 go together, part of a section. 18 continues the lesson on how to run your business, how to finance it. 18 is more like how to do financial controls, how to raise funds. So let's get to what they're doing here. This is a great illustration of all the many things that financial managers do. Remember I said that the CFO, Chief Financial Officer, is the top guy for finance. Very good position in the company. It's pretty much like a number two behind the CEO. And the CEO and the CFO know what's going on. They have to look at auditing, taxes, advising people on management, collecting funds for credit, controlling, getting funds, budgeting, how much is an expansion going to cost, how do we plan for that? So those are the things that CFOs work for. And basically what we're talking about is avoiding failure, which would be not having enough money, undercapitalization. If you don't have enough money to do an expansion or go into a new country or to hire people, you're not going to make it. Cash flow, we talked about a few times. It's always a challenge. I've got an example. I'm delivering something right now. I won't get paid. And this is thousands of dollars. I won't get paid for this for a while. Even though I delivered, I can't just expect to get a check when I deliver every time. They have to cut checks, so at least it's a few days. So how do businesses handle that? Every time you deliver something, you have to wait for money? That's how it works a lot of the time. And just poor expenses, obviously, when you're just going crazy and spending money on anything that you want. With no control, a firm can fail. Here's a macro view, is big picture. What are the CFOs and CEOs thinking about? And it has to do with big picture consumer demand or government policies, price pressure. These are all the macro issues. Global strength of market. And then the micro issue is, are we as a company able to still manage margins and bring profitability? Are we able to forecast how much is this expansion, how much is this new territory, how much is this new plant going to give us? It's a lot of financial planning has to do with seeing the future, which of course nobody really can see the future, but a good financial planner will see where we're going and be able to make predictions. So it's kind of crystal ball work. That's why they're paid so much, because they know what's coming down the road. What are we going to do? What does the industry look like down the road? And of course, they have to work with healthcare and capital and all that. These are things within the firm that the company is concerned mostly about. So a good planner will come up with a financial plan that has short-term and long-term. Both directions are important. What are you going to be in next month? Obviously short-term. Where are we right now? What do our sales look like? What's next quarter showing? Where are we going to be? And then long-term is, if you're going to take a loan for 20 or 30 year or sign a lease for 20 or 30 years, that's obviously long-term. But where do we want to go in 5 and 10 years? And a budget will allow for that. And there's financial controls. There's a feedback loop that gets back to the financial planner. So you make a budget and see if that budget is being adhered to. There's no use in having a budget or a financial plan if you're not following the steps. Again, the roadmap. If you're not following the roadmap, you could very well find yourself lost. You have to think about short-term and long-term, of course. 5 or 10 years. Companies, I can tell you, most good companies know what their plan is, where they're going to be in 5 and 10 years. And so everybody has a budget. There's a big CFO can hand out smaller budgets to different departments. Here's marketing budget. Here's what you have to work with. Here's an operational budget. Here's how much you have to work with. So the big picture is to hand out different budgets of what people are supposed to work with. And it's your guide of how much you can and cannot spend. Pretty simple. Anybody ever have an allowance? It's the same kind of thing. And we are always looking at the balance sheet and income statement and cash flows. Those are the things that are basically the budgets, the things that we learned in the last chapter. And again, the control is where a company will take a look at where our expected costs are and our real costs. That's the important thing, is to look at what's really happening based on what you think might be happening. Pretty simple idea, but not everybody gets that. So a quick word about where funds can come from, and we've talked about this. There's debt financing where you're borrowing. You just go to the company and borrow money. Equity financing is where you provide ownership for the investment. You watch Shark Tank. I will take 20% of your business. You give me 20% of your business for this amount of money. That's equity, putting equity in that. And we talked about short-term and long-term funding already. You should know about secured loans and unsecured loans. A secured loan has collateral, of course. Your car loan and a house loan typically are going to be the secured loans. Equipment and plant and truck, that kind of equipment type working stuff is secured, and unsecured is no collateral. Maybe think about a credit card. You don't really put anything up for a credit card. An important thing to work with in a business is also a line of credit. The line of credit is an inexpensive way to have credit where you pay as you use it. So you have a $40,000 line of credit. Sometimes you need money, and that's part of cash flow. So you take down $10,000 that you're going to pay in a few days, and it comes back down. It goes up, goes back down, up and down, up and down. And it's just a line. It's a revolving line of credit, and it's pretty effectively cost effective because you're not paying all that much interest. And when you don't use it, you don't pay interest. When you do, for short periods of time, you pay interest, but then it comes back down. It's a revolving line. Very important for businesses to be able to work with their cash flow and revolving lines of credit. And the collateral, of course, is the mortgage has a house as collateral, and we all can figure that one out. That's pretty basic. And here's a quick list of types of financing: debt and equity financing. Remember that if you go to a bank for debt financing, there's no management. That's an important distinction. If somebody's going to put money in and expect ownership, it's probable they're going to say, I want to help manage this company. That's a big difference right there. And you can see different types of repayment and obligations and tax benefits and things like that from this. This is in the book. But it's important to understand that a lot of companies can take some debt and some equity. It can be a combination of both. Equity could be a very good experienced person who can come in and help you manage the business, and his experience brings value to the company. So you want to take that kind of equity. So rich Uncle Joe doesn't want to just throw money in. He's a good salesperson, so he can get in there and get sales. So he would receive equity for some of his investment. And that's it for chapter 18. Thank you.